morning and welcome to our latest virtual roundtable brought to you by Bridging and Commercial and kindly sponsored by MS Lending Group. Thank you very much for joining us this morning. My name is Beth Fisher. I'm the editor of online titles Bridging and Commercial and Development Finance Today and the bi-monthly print Bridging and Commercial magazine. Today, we will be discussing how the plight of surveyors is impacting the bridging lending market. One of the most integral parts to assessing risk in the lending process is under serious threat and could result in less choice, slower transaction times, and a hike in valuer fees. B&C has been reporting on the hardening state of the PI market for valuers since early 2019 after Lloyd's of London commenced a risk-based oversight programme on the sector the previous year. Since then, there has been a gradual decrease in insurance capacity. The PI issue is one of the biggest threats to the valuer profession right now and the success of the wider bridging industry. While it is difficult to point the finger to one thing or party as to why this problem has happened, we know that the PI sector currently has more demand than supply, meaning that rates and excesses have skyrocketed, insurers are writing smaller limits, policies are offering less cover, and firms are experiencing severe delays in receiving quotes. The Grenfell tragedy, Brexit, COVID, confetti claims by inexperienced bridging lenders, and insurers' misconceptions of the short-term lending market have all contributed to this. But what exactly does this mean for the bridging lending industry? With large surveying firms less likely to face as much trouble getting PI cover due to being able to afford the rising premiums, we found that smaller and more nimble valuation firms, crucial to the quick turnarounds you get in the bridging market, were likely to be affected first. In 2019, we thought things couldn't get worse, but unfortunately, we haven't seen much positive change since. A survey by VAS last year found that 89% of valuers saw the price of their PI escalate, with most reporting a 20 to 50% upsurge. As a result, 68% of valuers have hiked up their prices. The harsh landscape has also made 70% of valuers reconsider whether or not it is worth actually working in the bridging sector, which could make it increasingly difficult for lenders to place valuations in fast timeframes. Valuations are frequently cited as the cause of transactions falling through, with the phrases downvalued, more expensive, and slow often verbalised among bridging brokers and lenders alike. While the concerns are genuine and will ultimately impact borrowers, I'm keen to hear from our panel today on whether they think they are fair and if they think there is more that other parties in our sector can do to positively change this situation. Joining me today to discuss the common pain points that brokers, borrowers, lenders and valuers themselves are currently experiencing when it comes to the valuation process are a fantastic group of experts in the bridging finance market. So now this is a good time for me to hand it over to them, who will each spend around 2 minutes introducing themselves. We've got two Michaels here, so I'd like to start with Michael Stratton, please.
Good morning, everyone. My name is Michael Stratton, Managing Director of MS Lending Group. I'm responsible for overseeing the general business strategy, whilst doing that, obviously maintaining relationships with a lot of the brokers that we currently work with, also our direct customers, and managing and looking for new relationships with both direct customers and new brokers to the market. And I think the topic that we're talking about today, which we'll obviously go into in more detail, is really prominent at the moment. Just speaking beforehand, we've all got a lot to say on it. I'm really excited to get stuck in, and I think there'll be some sort of contrasting views, but I think it's something that's really, really important, something that we do talk about because it's an issue that we're all facing, and we're all in it together. It affects everyone, so I think rather than be a blame culture, it'll be really good to get some of everyone's opinions out in the open. We've got a lot to say on it, and I'm really happy that everyone's joined so we can all discuss it.
Thanks for that, Michael.
No
and
problem.
Michael Street?
Good morning. Yeah, Michael Street, MS Lending Group. I'm the lending manager here at MS Lending Group. I joined the business following Michael Stratton laying fantastic foundations for us as a new bridging lender. My role consists of dealing with a lot of these wonderful people and building out on longer lasting relationships with customers, brokers, but also panel surveyors and lots of other people in the industry who will again have very important opinions on this topic. I think through the life cycle of a loan facility, evaluation is of course an important part, whether that's at the point when we're actually discussing the new inquiry, throughout the term of the facility, and also then on redemption and bringing somebody to a close and helping them either source alternative finance or passing them on. So it's going to be interesting to find out everyone's opinion, including yours, Beth, of course, on where we can take it and what ideas and suggestions we've got for the rest of the market as well.
Thanks for that, Michael. Daniel?
Hi, my name is Daniel Owen-Parr. I'm the MD of VAS Audit, which is part of VAS Group. We're a group of companies that are basically built around panel management, and predominantly sort of 60% of our business all comes from this market. You know, we're doing around 1,000 valuations a month across the whole of the United Kingdom, and the sort of VAS Audit is seeing sort of about 150 different valuations a month. So we're really interestingly placed to see what the market's doing, and we're really looking forward to adding to the variety of opinions today.
Thanks for that, Daniel. And Aaron?
Good morning. Thought you'd never get to me, but it's great morning. To introduce myself, Aaron Noone. I'm one of the leaders of Master Private Finance. We're an intermediary, master broker and packager. Been in the industry for about 15 years, for those who know me. Previously worked at loan.co.uk, and then prior to that at Together, or Blooming Group, for those of us that remember its old term. This is a really hot subject for all of us, and I work with MS Lending really closely, and the subject of valuations comes up quite often. Having worked for a lender previously during the 07 crash, I'm familiar with what happened to cause a fallout between the lender market and the surveyor market. And whilst there's a bone of contention there, I believe it's about bringing it in and being collaborative and working with different panels and different surveyors to find a solution for how we can move things forward. So whilst we might reflect maybe on our history while we're talking about this, I really do think the tone we need to strike is one of collaboration. Otherwise we won't achieve what we want to, which is we need to make money on our margins. We need to make sure that the customer isn't paying obscene amounts of money for a low value property because of PI being the explanation. What can we do to get it better? Otherwise the lending market will diversify, and that could cut out surveyors even further forward. But we need them just as much as they need us. So for my opening pitch, let's work together.
Thanks, Aaron. Meir?
Good morning, everyone. Thank you, Beth. Thank you, Michael, for inviting myself. Great panel that we have here today. So my name is Meir Peer from Redi Finance. We're brokers. In the past, I've worked with some other lenders, with some of these guys actually over here, and I've had several roles with other lenders. So seeing different appetites and the way different lenders approach different products and the way that the valuers that they work, it's very interesting. It's almost like a culture shock when you go from place to place. And then 13 months ago, on the back of the pandemic, I started doing this, and now I'm seeing it even more because now I'm speaking to more lenders. And it's interesting because my clients rely on me to, when we instruct the valuation, they expect to get what they're saying the value is, and if it's not what they want, it's almost like, you gotta get stuck in this situation where like you don't even know how you can help them, and then you're chasing around, and it's something that we talk about, all of us, even when we're not trying to. We're always talking about it, and it's really the root of everything we do, the values of the property. So great debate, really looking forward to it. I'm sure it's going to get heated, and I hope our attendees will take it easy on us.
Thanks very much for that. And last but definitely not least, Adam.
Good morning, everyone. My name is Adam Klein from Atlas Property Finance. So we run a boutique property finance service house that looks after developers and investors and helps them raise capital across a variety of assets across the UK. And delighted to be here this morning. Prior to working at Atlas, I was at Lambert Smith Hampton for 5 years. So valuation topic is always something that I'm interested in, and working with valuers across different deals on a day-to-day basis is something that's very, very important. And I think this topic will reduce the barriers and reduce the boundaries that we need in order to move deals along much quicker.
Thanks for that, Adam. So now that we are all introduced, I just want to remind the audience today that you can submit your burning questions that you've got throughout the hour, and you can do so by going into the right of your screen. You should have a little control panel and a little chat box function where you can submit your questions as and when, and I'll be filtering through those and asking them and presenting those to the panel either throughout or at the last 5 to 10 minutes of the discussion. So please do ask questions that you have. Okay, great. So I would like to kick off with my first question, which is all about how lenders, bridging lenders' approach to valuations have changed. So Michael Stratton, I'd like to know kind of where you think this has changed from a lender's perspective and why.
Yeah, I think obviously when between Daniel, between the other brokers, it'd be interesting regarding the wider market. But for us at MS Lending, we have closely thought out our business strategy, one of the main things being valuations and how we can try and have the foresight looking forward as to what issues valuers are having, how to make their life easier, which also makes our life easier, and ultimately having the customer's best interest at heart. So we quickly, when I say we saw what was coming, we've seen for quite a long time now the difficulties that valuers are having and us as lenders, clients are having in relation to turnaround times, in relation to cost, and ultimately the effect that PI cover is having on valuers and the squeeze that that's having on them. So we've had to evolve and think of ways that we can combat that whilst obviously mitigating the risk to us as a business. We've created new products, which may be sort of not full valuation products. We have desktop valuations, we use AVMs, and we have to closely align what our risk as a business is as to when we can use those products. And I think a lot of lenders, it depends on their funding lines as to what they're able to do and what they can and can't do. Fortunately, we as a business are able to take advantage of those different opportunities in the market, and I think it's working really well for us, and something that we're going to look to continue to use moving forward. I understand the difficulties involved. Like I said, a lot of lenders don't necessarily have that privilege, but I think it's something that lenders are going to have to start evolving and start sort of looking at the bigger picture, because I don't think it's going to get any easier anytime soon for valuers. As you mentioned at the start, Beth, the smaller firms who typically are more agile and nimble, they're feeling the squeeze massively in relation to PI cover. And I think it's a collaborative effort from both lenders and valuers and brokers to work together, because it's a vicious circle. Lenders push valuers, they do the valuation quickly, they rush the valuation. The lender then blames the valuer for being negligible because they rushed them to do the valuation. It costs, their PI cover goes up because they're claiming on it, and we're back to square one again. So lenders have a massive responsibility in the marketplace, because we appreciate valuers and we appreciate the work that they do and what goes into it. But we as a business have also had to have the foresight to think about ourselves and our customers and how we can sort of stay ahead of the curve. We have done, and it's working really well, but I think it's important that other lenders take heed as well.
Agreed. Daniel, you obviously work with a lot of valuers as part of VAS and a lot of lenders. So I'm sure you've got quite a good view of the market and how lenders' approach to valuations in particular have changed. So it would be good to hear your thoughts on this.
I have to declare at the start, though, it's a bit of a poacher turned gamekeeper here, because I spent 17 years prior to this as a lender, so I've seen both sides of the story, and so it's a very interesting market. I think Michael very eloquently explained around the point of being a collaboration, and we have to move away from this us and them, because the market only works with all parties involved and all parties pushing together. Let's be realistic about the valuation market. The average age of a valuer is close to 60 years old. 2000, I know Aaron talked about sort of 2007, 2008. That had a really big effect on the valuation market, because it wasn't as good a position to come in as a graduate to sort of pick what you wanted to do as a degree. Would you want to go and be a building surveyor or a normal surveyor? So we've lost a generation of people coming into this market, and like a lot of traditional professions now, they really aren't bringing the best and the brightest in anymore, because there are so many other careers that they want to go into. So we have to be very careful that the resource we've got is ever decreasing. And let's also be very realistic that these guys are tired, or these guys and girls are tired. We were on a call with somebody from a fairly senior, very large sort of valuation firm, and he was saying that the guys are tired. They've worked from home, they've worked under great deals of stress for a fairly long period of time now. So what are we seeing differently in the market? We're seeing that people are moving away from red book valuations on everything. So the next one down is sort of a short form valuation, but we're hearing lenders using AVMs. Michael talked about desktops. We're seeing that. So I think the market is evolving, trying to look for ways to speed up as such. But I still don't think we're ever going to move away from a human being entering a property and having a look round and giving a professional opinion on that. I think that's still going to be the core of what majority of our valuations are going to be. But for the slightly smaller, slightly more standardized, closer to more concentrations of chimney pots, then I think the market is very open for innovation and exploration, to look at something that gives us as much as possible. I've seen some really interesting technology out there with drones and other types of things. I don't think we're quite there yet, but I do think that the lower end of the market is prime for some innovation to come in on the back of it.
Thanks for that, Daniel. Aaron, would you agree with that lenders are moving away from red book valuations, and what kind of impact, both positive and negative, is this are you kind of seeing as a result of this?
Yeah, I mean, well, if we ask the question out loud, what's the value in a valuation? Why do you need one? Because having worked from a lender before, from a repossession perspective, we might be making that decision 3 years later because you've entered into forbearance with them. If you're a lender that has got absolutely no appetite to repossess, then why do you have the valuation? Is it a box ticking exercise because you need it for your funds later on to evidence that you've done a good job? But we all know reasonably at the start of the transaction what the value of that property will be. It will be a range, and we'll go, well, it's going to be between this and this, because we're in a digital age. We have access to land registry data. We have access to Rightmove to see what's for sale. We can have a look on various platforms to see what it's sold for. So when we go, oh, we've had a down valuation, it's not met our expectations, but it probably is within the range that we thought of before. So if you've got a lender which is saying, right, well, we're getting complaints because it's us that have to deliver to the broker, that valuation is £600 for that £100,000 property, and the broker then moans at the lender. What do we do? Because we're in a trapped situation. The market in a capitalist society will diversify. So you find that you've got lenders who will say, well, there's no valuation. People might say, oh, well, what a huge risk. That's outrageous. But if you're at 50% loan to value, it's a property within a dense urban area, and there is active sales and sales data in there, Why do you need the valuation? You need it for a box ticking exercise, because you go, yeah, that's right, put it to one side, no problem. Sometimes it might tell you something particularly unusual that you weren't expecting, but then the lenders have to make the decision. What is their attitude towards risk? Because if they have a delinquency book and it's less than 5%, as it were, then they're making the right decisions front end. Do you have a team that reasonably knows the value of a property? What are we looking for in a valuation? Somebody else's opinion, local in the area, as to how much that property is worth. And then when we get to the point where we repossess and we have the fallout like we did in 07, we're saying, well, this valuation that you did 3 years ago, we're completely unhappy with it. Well, you were happy with it at the time. So it's both sides need to get over the fallout that we had before and look at positive ways. But lenders reasonably here need to be the first that come to the table to say, on this type of case, on this type of property, in this type of scenario, we want someone to go in and take a look. But if we've got a house in East Manchester with 5 sales that have gone on in the last 2 years, what value is that adding? So can lenders diversify their range and adapt? So then you're giving a clear message to the surveyors to say, this is why we're doing evaluation. These are our unified expectations. And at the end of it, if it doesn't quite go to plan, we've already pre-agreed with you what we will do later on. Because PI, as we all know, is a cover for risk. So the FCA have defined bridging lending as high risk. Of course it is. It's 12 months lending, but it's regulated as well. So what is the overall risk we're doing? Are our lenders reviewing their book, or are we just glued to wanting evaluation because, well, we've always done it? But that's the definition of madness. We've got to take a positive look at our industry and say, do we need evaluation? If it's worth £500,000 and we're doing a £100,000 bridge, why do you need evaluation? It's not going to tell you anything other than you've got loads of security. So you've got to, as a lender, make a decision, but you've got to communicate that, because we have a spread with lenders who say, we'll get it to us first and then we might do an ABM. At that point, we're a bit nervous about where we're placing it, because somebody else has said, we'll definitely do an ABM, but it's a higher rate. So people, you've got to give a clear message to us, and the broker market will adapt. We will sell, we will advise, we will recommend whatever products that we've got available that meet the customer that's at our door, and that's where we need to change, and then communicate that clearly to the surveyors.
It's really interesting. Yeah, there's definitely some blurred lines on where the where lenders are relying either on the valuation or their own underwriting. So I think that will be an interesting conversation moving forward. As we emerge from the pandemic, what differences are you all seeing in terms of valuations in different sectors or areas across the country? And how is this impacting the available finance for these assets? Michael Street, do you want to start with this one?
Yeah, I mean, I think Dan sort of alluded to this a little bit earlier on in his answer to his previous question, and that we've got a growing age group of surveyors who are available, and the number of surveyors is dwindling. So I think from my point of view, every time that we get a property in an area which is a lot higher risk, I mean, again, Aaron just pointed it out that for, you know, a 2-bedroom terrace in East Manchester at £80,000, what's the requirement and the necessity of evaluation? It is very, you know, very minimal. Even at sort of 70–75% of loan to value against the purchase price. Whereas if, you know, that's not what the bridging market does. You know, it's that is a lot of it. And we do help a lot, especially in the auction sector. That is the type and part and parcel of business that we do. However, with some of the larger scale and more high risk properties, that for me is where values do come into their own, because the evaluation report, it isn't, you know, it isn't a figure in the air. It is an evidence-based report that we can't speculate on, you know. So it is something that surveyors have to go out to the market. They have to research the comparable evidence. They have to go and see the building to see and to measure up the square footage, because that data isn't always readily available, especially on some older properties. In terms of geographically, the north, of course, is becoming a lot more prominent, and a lot of investors are moving out towards the north. The south is a strange market. You can drop over a number of years from, especially in London, in 15 to 20% at times, and we've seen that, and that's been evidenced. And I think from my point of view, we need to bring more surveyors into the market who have got an opinion on, so for example, 2020, 1,700 new surveyors qualified as a RIC surveyor. They're new surveyors coming into the market, and the people who are bringing them in and training them haven't got the time to be able to train them and provide them with that experience and with the ability to do what they need to do. So it's a changing demographic. But I think from a geographical point of view and from a risk perspective and from a type of property perspective, there is always going to be different types of properties that create more high risk, and the need for surveyors and valuers is very, very important in my opinion.
Thanks for that, Michael. Meir, what would you add to that?
So I'm just connecting really what Dan said and Aaron, and then what Michael Street just said. So with the changes, I mean, Dan was just saying how he believes that we're always going to need a surveyor to go out and see a property. And then Aaron said, why do we need one, right? So you look at the changes, following from what Michael was saying, is that during the pandemic, when we were in tiers, like not literally crying, but like tier 1, tier 2, tier 3, when we couldn't get surveyors out, obviously for the risk. So you saw a lot of lenders who were all of a sudden saying, AVM, desktop AVM, just to keep themselves afloat. And then all of a sudden, as we've kind of come out from it, then now you're only seeing a handful. So a lot of those lenders who that kept them going with the issues of valuations have now gone back to their original methods of having someone there in person. So it's funny how that's worked out. As far as different properties, I'm on board 100% that the residential, or if loan to value, where we do have the access to it, when a client comes to us and says, it's worth this much and this much, I'm going to go ahead and have a look myself. It would be silly of me to just go ahead and send it to a lender and say, I'm just going to make myself look silly once their underwriter looks, and there's just no way. So my job is to obviously tell the client, you're reaching with that. I don't think so. You know what I mean? We have to have that honest conversation. Obviously, you want to, the higher the figure, the higher the loan amount, and you kind of get stuck in that battle. But you have to do what's right for the client. The lender will always want to make sure that their client could come out of this bridge safely. So it's tricky with how the desktops, for instance, it's great for us because it makes everything faster, and it makes everything more the whole process. You don't have to wait as long for quotes, but then obviously you have to make sure you could get that client off that. It's just yeah. Hope that made sense. Sorry.
I think I'd add as well. Sorry, Beth. I think what we have to remember with the majority of the business that we do in a regulated market, for example, the consumer, or the consumer that is actually purchasing property, when they're looking at a value, they're looking at their dream home, they're looking at a house to move into for the first time, and they have a personable relation with that property. And if a value doesn't come in at where they expect it to, then it is fairly heartbreaking, or for example, it just doesn't work for them. Whereas the industry we're in, the specialist market, whilst there is a value to a property, for the most part, if a customer has an opinion of value, there is a reason behind that. It isn't just somebody going to buy a house and going, I love it, I want it. There is a reason behind that. So whether that's investment value, whether it's hope value, whether they can see a yield on that property from a service accommodation perspective that a surveyor from a bricks and mortar point of view can't, then that also plays a part as well. So I know from previous experience and the specialist market in itself, and Beth, you mentioned it before, we've moved from a bricks and mortar asset type of industry to a customer and client type industry, where we're looking more towards, and this is very responsible, by the way, we're looking more towards an accountability and affordability and a customer perspective rather than just asset based. So when a customer comes and says, I know it's worth to me £300,000, bricks and mortar, it might only be worth 210, but they know that on their return of investment, they can increase that value for a resale to an investor in that space who specializes in it. So when we say value, it isn't the value of the number that's written on a piece of paper. It's what's personable and relative to the customer, whether that's a limited company, whether it's a partnership, whatever it may be. It is personable and again relative to how an individual or an entity sees that value as well.
And that's really where the lender and broker comes into play as well, you know, really getting behind the story of a particular borrower, their track record, and what they kind of envisage that that property and the progress of that to happen. So yeah, no, I completely agree with that one. I want to move on to the common pain points that brokers, borrowers, and lenders, and also valuers themselves, are experiencing when it comes to the valuation process. So we've obviously talked a little bit about the differences in tech which have come in, but are there any other kind of hurdles which you're experiencing? Adam, do you want to kick us off with this?
Certainly, thank you. So I think over the past 18 months, it's been very difficult to find comparable evidence on market rents, on sales, that you can use compared to the market before and coming out of a pandemic. There's a lot of pressure, I feel, on valuers to look for the right comparables that will help get a valuation sort of where it needs to be, in the sense of when someone's valuing something, is it done on pre-COVID levels? Is it come on the assumption that we're now coming out of the pandemic, markets returning to normal? Then there's obviously issues where you're wondering about supply chain issues. Are we going into a recession? Which I don't think we are. I think we're recovering very well. I think it's very difficult to find comps over the past 18 months, if you were to go out on a valuation today, that really are accurate for current market conditions. I don't know if the other valuers find that. Obviously, over the past 18 months, having access to properties has been very difficult, especially where you've got a block of a multi-unit freehold of flats. Every tenant is not going to want a valuer going into their home, which can make it very difficult if you can't see every unit. And obviously the timescales to instruct a valuation, for valuers to come back with quotes, and then to get the report back, it is taking longer naturally with more people working from home, and obviously restrictions in transport that we've seen over the past maybe 18 months.
I would say, if I could just add on that, the main pain point that I'm sure every broker will see is reading a valuation report and it says, because of Brexit, because of COVID and the pandemic, because of the impact on cost of materials, I believe that this valuation is this. And what actually happens is we're in unprecedented times and nobody knows the future. So you end up with a broker saying, no, my opinion is this, with the client and with the lender, and a surveyor saying, well, my opinion is this. You think, well, none of us were alive during the Spanish flu, so we have no idea what the impact will be. We don't know what furlough will be, but house prices, because of the reduced stock, are through the roof. So you're in an area where someone would evidently pay significantly more for that property, but a surveyor will downvalue it, and that is because they are afraid, because we will come along and sue them later on if they get it wrong. And that is where it's going wrong. They're going cautious, because why wouldn't you? You would, of course you would go cautious, because that makes common business sense. I don't want in 3 years' time a lender to breathe down my neck and say, because of COVID and because of Brexit, you should have been more aware that the inflation in house prices was artificial and we were actually going to go into a recession. Nobody here and nobody listening genuinely knows what will happen. We could boom. We've just come out of Brexit. We just don't know. So they're erring on the side of caution. So there is an element of that which was caused by what happened in 2007, but we are at loggerheads because it's an opinion, and that is, I would honestly say, I would argue that is the #1 reason we are getting down valuations, and that's the #1 hostile point between us, because we are arguing on speculative, so we can't win. And a surveyor, if anyone's managed to have a surveyor change their valuation figure in the past couple of years, you know, hats off to you, because that's practically impossible. Once they've written it down, even if you provide significant evidence contrary, they're not changing that valuation report. what they've given is what they've given. So there is no room for us. We don't have any room to negotiate or to offer valuable evidence. So we feel left out of the discussion process, which makes us feel inferior to the surveyor. And then that creates a hierarchical fight between us when actually we should be more collaborative. And that's where I think we need an overall relationship change, where all of us have to change and be honest. Otherwise, we're going to continue down this path, because the impact of this the recession was 10 years we were within that crash. This will be even longer. So we've got to do something now. And as Meir said, lenders were very, very quick to change the valuation policies when all of a sudden we couldn't get any surveyors. So what changed? So if you were willing to change your criteria then really your appetite for risk is a little bit higher than you're advertising. It's time to change. So it's a little bit from column A and a little bit from column B.
A really interesting point there on in terms of collaboration, and I'm often told, and I understand that, you know, valuations are an art. You know, it's an art form, and it's something which you know, it's an interesting profession. And I want to know from Daniel and his point of view on what he thinks in terms of collaboration and the final answer on valuations.
I'll come back to sort of Aaron's point there. It's an evidence-based art form. So, you know, we'll cover the terminology down valuation in a little bit. But, you know, I have interactions with a lot of valuers, and I don't get a sense from them that they're particularly going out there and supposedly being very risk averse. Because yes, I know Adam was saying there's less available evidence out there because there was less transactions, not within the residential space predominantly, because there's been a lot of movement over the last sort of 18 months really, especially building up to the end of the stamp duty changes. So there's a lot of evidence within that market. But if you go more specialist, so sort of HMOs, quite large HMOs, commercial, some semi-commercial stuff, then yes, there's a lot less evidence in that. So I do think, yes, it is an art form rather than a science. It is somebody's professional opinion who has studied for many years, who's got a lot of experience, and I don't get the sense from anybody that I speak to is that they're trying to protect their PI by being very risk averse, because that's not really what they're there to do. They're there to give an evidence base. So if they're giving you numerous comparables sold and on the market that reflect the square footage of the foot and of the property, and also the state of the property, then that's really what their opinion is. You know, coming back to the other points you made as well, with around sort of like collaboration piece and also getting something overturned, then, you know, I can only talk about VAS panel. We do have, you know, 190 valuation firms. We have a number of people within that help around when we got a query either from a lender or from a broker around the difference or you know, you use the word, Aaron, expectation of the client around what the figure should be. You know, I have seen where a valuer has changed because there's a piece of evidence that they weren't aware of. You know, no one's infallible. You know, we've mentioned Rightmove Plus, but I think you've got property data, CoStar if you're in the commercial space. There's a lot of information out there. And I think if the client, through the broker or directly, or even the lender, can come up with something that wasn't in the original valuation, which then counters that opinion and puts that across. But too many times I've seen the owner of the property believes it's this price because one property sold down there for a while ago. Then that doesn't work. But if you come back with evidence-based stuff, then I have seen them. You know, there's not massive amounts of them, but I have seen them change. So you know, difference of opinion, but you know, we're coming from different points of view. But I do think the collaboration piece is hugely important, and I'm right with Aaron that if we can all work together, you know, valuers don't want to work against the market, you know, and you know, coming back to Michael's point of the 1,700, you know, surveyors coming into the market, you know, the valuation market is massive. It's not all about valuers doing property for lending purposes. There are so many broad areas they're doing that. So would you want to get into a market that's highly stressed, wants everything back really quickly? If you're dealing with a diocese down south, who wants properties valued, who have no expectation on timeframes when it's coming back, and the good fees, why would you operate in the lower market? So I think we have to, as a marketplace, want these people, attract these people to come and work in this place, and we need to work collaboratively to do that.
Can I jump in? Oh, sorry.
No, go for it.
Yeah. So you mentioned obviously opinion a few times. You said it, the valuer's opinion. I think the red books, the Rick's red book, their manual will always say it's the opinion. And then we're talking about collaboration, but I feel like it almost needs a bit more collaboration between surveyors themselves, because you're seeing different reports for same properties. So if you've had two different surveyors doing the same report, and one is very size driven and another is very comparable driven, but then the numbers are completely different. And I think that's something that also is creating an issue. Well, it's obvious, it's the opinions. There's no real unified way. I mean, at least in our sector, the bridging, which is what we're really mainly covering right now, you have the same person, two different people valuing the same property, completely different, and that often creates these situations.
I think Daniel alluded to this earlier as well, but do you think this is potentially due to the timeframes which lenders are expecting the valuations to come back in? We B&C report a lot on lenders celebrating 24-hour loans and loans within 4 or 5 working days. If you're being instructed to do this at a quick pace, and like you say, there might be information which hasn't been passed on to them which could change their opinion. It's difficult to get all of that in a short space of time, surely. I'm interested to know.
Yeah, you've also got to be aware that the red book is not a defined rule book. It's a guidance on how to perform that, and I think that's what you really need to understand. So there needs to be a methodology. So originally there needs to be a lender instruction letter that sets out how the lender wants this to be valued, and in essence there's 11 sort of ways of valuing a property, and to get a figure at the end of it. So I think sometimes you've got to be careful that you're comparing apples and apples, not apples and pears, in the way that the valuation instruction letter has been brought out. And I think ultimately it's a methodology which sits around the comparable evidence. What is the evidence in the marketplace saying? If there is less evidence, it will be more of an opinion. The more evidence that's there, the more properties, it will be more driven by science. It will turn around and say that the square footage for this type of property is between this and this. And from my experience of 25 years, I would say it sit in the middle of that. But yeah, it is an opinion, but it's an evidence-based opinion. And I think you need to put the evidence bit on the end of that opinion.
I think Meir makes a fantastic point, which is when you instruct a survey and you've got comparable data and it works for you, and you get a completely different opinion from another surveyor, but I can go to funding from the other surveyor. And that lack of strategy and the varied outcomes with the same parameters is where we then say, what are we actually valuing, and why is it so varied between the different surveyors? And that lack of it, maybe it should be a science and not an artwork, because maybe we don't like the picture that's being painted. And I think that's potentially what we need to look at to see how we can streamline and unify the outcomes so that we've got more confidence in the opinion of each surveyor.
We've had quite a few comments come through, unsurprisingly, from both valuers and brokers, and I just wanted to share this. So it's not a question, it's actually just a comment, and I think this kind of tails on from what Meir was saying earlier about the the transition with tech during the pandemic and how that's changed things. So they said valuers now going back to physical inspections after desktop and ABMs during the lockdowns. As a valuer, we are heavily dictated by our PI. We tried to find workarounds where possible during the lockdowns in order to assist the lenders, but for us it was heavily caveated as our PI dictates that we can't do desktops on properties we've not previously seen. PI is more challenging than ever, having just renewed ours, and we had to go back to physical inspections in order to comply with the regulations. So I thought that was just quite an interesting thing to kind of add on there in terms of why we're seeing people go back. Which kind of tails onto my next question about awareness around the hardening PI market that valuers are facing and the impact it will have on the bridging market if valuers are no longer able to trade. We had some quite stark survey results from VAS earlier. So I'm interested to know what you guys think, especially for lenders who are looking to expand into different regions where, you know, smaller, nimbler valuers are necessary.
Yeah, I mean, in answer to that, I definitely don't think there's enough awareness of sort of the PI crisis, as it were. I was fortunate enough, I did a piece with B&C earlier this year in relation to that, and I think, as I mentioned earlier, it's a vicious circle, and what's happening is the corners that are being cut as a result for the pressure that lenders are putting valuers under, it's just coming back round tenfold and causing issues for the lenders, ultimately creating their own problems. That's not to say that you know, the brokers don't have a responsibility. I know we touched on before sort of the due diligence that's done at the front end, and I think to alleviate potential issues down the line, I think what ends up clogging the system are confetti claims, frivolous claims, just to appease customers, to appease brokers. But could we have done more at the front end as a lender, potentially as a broker, sometimes even a valuer? Yes, it's a business. Yes, you know, valuers are only going to get paid if they go out and do the survey and take the job on. But if a valuer sees at the outset that a property in North London that's a, you know, a one-bed masonette's never going to be worth, you know, £3.5 million, just because the customer thinks it is, or like Michael Street alluded to earlier, they have hope value based on, you know, something they've been harboring for a long time. Can we all collaboratively work together to think, is there any point spending the customer, you know, spending a valuer's time going to do it, spending a broker's time processing that application, the lender also, for it probably to come back round again with a potential appeal from the customer, taking more time from the valuer. And these are things that clog up the system. So I think there's definitely an onus on everybody collaboratively. I know there are issues with what advice is and isn't allowed to be given to the customer, but certain guidance in relation to our opinion as a lender, because ultimately if we are the decision makers anyway, sometimes just because a valuation says something, us as the lender don't have to lend based on the figures the valuer gives us. If there's something that doesn't feel right about it, then, you know, we're always within our right not to go ahead with the lend. So I think if we can see something at the front end, potentially the brokers can see something at the front end that doesn't make sense and doesn't feel right, the time taken ultimately then clogs the system up for everyone. And I think if everyone had a bit more of a conscious nature about them to think, you know, what can we do to sort of to quicken the process for everyone, I think doing a lot of the underwriting at the front end would help, because like we said before, the valuation is a great tool for us. It's something that a lot of lenders rely on. However, it's not the be all and end all. There's a lot more that goes into the case. So can we, rather than just think, let's just get the valuation instructed, let's get it done really quickly, maybe look at the whole case before we get to the valuation stage to check, are we actually happy to do this case, regardless of what the valuation says? Because we could be sending the valuer out to do a job that we never even need to have a look at the valuation, because there are certain aspects that we've now found out that mean we wouldn't have gone ahead with the valuation to start with. So I think that there's definitely something that we all could be doing on that front. And I think, yes, I think there's been articles more recently, obviously the B&C have been at the forefront of that, of raising awareness of the difficulties that valuers have. And it is difficult because we as a lender we're in a market where it's diluted, it's very competitive. And for us to win that business, before we even, never mind our rates, our terms, if we need a valuation and the valuer is either too expensive or they can't go out quick enough, we've fallen at the first hurdle and we'll point the finger at the valuer and say, you're not helping our business, so we'll probably look at alternatives elsewhere. But maybe, you know, an appreciation from everyone to manage customers' expectations at the start would help. But you know, that's me probably looking at it with rose-tinted glasses. It's a competitive market, and everyone needs to find an angle to win the business. And I think that's where we've seen the rise in desktops and AVMs. But people need to be aware that it's not valuers being purposely difficult. There is a big issue that, you know, it's going to affect us all if we don't address it.
Daniel, do you have anything to add to that?
Yeah, I think around instructing valuers at the moment in time, yeah, they're busy. There's no doubt about it. So, you know, for the smaller, simpler cases, then yeah, AVMs, they have their limitations. Let's be realistic. You know, it's an algorithm and it works very well if there's a lot of chimney pots in the area and there's been a lot of transactions. But you know, outside that, it's fairly frail. You know, desktops. Yeah, I'm aware, you know, in the COVID times, you know, they went out and did that, but whoever came back with that comment then has very eloquently explained, you know, the issues. You know, part of the VAS group, you know, now does, you know, the VAS Audit now does desktops, but they come very heavily, you know, guidance on that. This is a guide for you rather than a specific, because no one's been out to see the property. I think there's got to be an appreciation, but you've got that sort of catch-22 that Michael was talking about. It, you know, for a lot of clients, they come because they want speed into the bridging market, and the first come, first serve. So I think, you know, as a lender, you're probably going to have to be, you know, holding nerve to a certain degree, especially with slightly more specialist property. With less specialist property, then you've got the ability to use other technologies to do it on that, and you've got to make that find. You know, I think Aaron, you know, quite eloquently explained before, it's a risk-based thing, and a valuation is not going to cover all bases for risk. There's a, you know, I remember there's an acronym I learned, you know, 18, 19 years ago about how to lend money, and security is only one of, I think, 9 other things to think about. So I think it's important to put it in context there. But I will come back to my first comment about, I do believe that, you know, valuers will still be needed to go out to see, you know, a good proportion of properties on there. But if you've got this 80 grand property in East Manchester and you're only lending 50%, then I'll challenge the lender to say, why would you need a valuation on that?
How do you all think that brokers, borrowers and lenders can help alleviate pressure from valuers and speed up the process? Just following on from what Michael said earlier, it'd be good to get all your opinions on this.
I think providing information in a swift and timely manner to valuers, so there's no surprises. If they've got all the information up front, they're aware of any restrictions on the property, any sort of marriage value, anything else that may impact a valuation, as opposed to them arriving on site and being like, oh, we didn't even know the planning reference, we didn't know that planning had been granted. It will give them the full picture to sort of allow a swift turnaround of a valuation report. And I think you have to work with the valuer, and even sometimes showing the valuer local comps, what has sold recently, providing as much information as possible is only going to benefit the application.
I'd like to just quickly second that from Adam. You know, from one of our biggest issues in VAS panel is the lack of information. You know, I can come up with many different scenarios where we've had issues where we've not been given the full details up front. And we've gone expecting a residential, and then it's a semi-commercial, or we expect a full building and then it's partly knocked down. There's numerous scenarios. So I think for the lenders and brokers in the market on this call today is the more information, and as Adam rightly put, if you've got comparables yourself, then provide them. You know, it's anything that you can aid a valuer can only support to make that decision they're going to make in a timely manner. But the more time they've got to go around looking for things and finding things and going on portals, you know, the longer it's going to take. So I absolutely wholeheartedly agree with what Adam said.
Thank you.
We have a question from the audience. What do you think will happen if surveyors don't adapt to the specialist market? Be interested to know what your kind of worst case scenarios would be. Aaron, do you have an opinion on that?
It will move. We always got to remember it's a capitalist society, so supply and demand. So if we end up in this position where we've got a significant amount of customers who want bridging finance, let's say, but we can't get the surveyors, the lenders still need to make money. They will adapt and they will change. They will change their lending parameters to range from no valuation to eval to desktop to Barry in the office who knows the local area. He can go out and say, yeah, I think it's worth that amount. Lenders offer, you know, there's hundreds of lenders in this market and it's a very hot space. So if one lender can capitalize on another lender's restrictive covenant for evaluation, they will, of course they will. And eventually then the others will change and they'll catch up. And, you know, we know some of the big banks who took ages to go to desktop valuation and only just embraced it because they had to, because you do or die. So if we continue this, and you know, special thanks to Daniel, because I kind of feel like he's been the defender of surveyors whilst we've just bombarded him with our grievances about, you know, they're terrible. I don't believe that, but you know, there's a valid place, and that's why I'm a strong believer in the collaborative approach, because cost is one thing. If a client really wants it, they'll pay for it. And it, you know, at the moment it's very, very high, and we complain about it because that impacts our ability to offer the advance and then us to make money in between. So we get nothing for a no, unless you're taking upfront fees, which not many do nowadays. We lose money from processing that case right the way through, and then we get the valuation, or they say no, I don't want to pay for it. We will all adapt in ways that we can't all communicate freely with one another, because we operate our businesses independently and we adapt to whatever marketplace that we've got. We need the surveyors, as the lenders have said today. We need to go in and say that. But when do we need them to go in? So as Daniel might see, we might be sending them into a property where we know we're going to get the value all day long. So we're putting significant strain on the surveyor checklist and the surveyor items that they need to go out and see, when really do we have to? But if we're at 75% loan to value on an £800,000 property with no comparables, we need a surveyor. That's what we need. That's what we need them for. So can we help the market by diversifying, managing our risk, being uniformed in what our risk is? Otherwise, it will end up impacting where people, brokers who are maybe newer in the game, will say, I'm not working with any surveyors. I only work with lenders who don't do valuation or do desktop. But then that's cutting off an income stream for a symbiotic relationship. So it's all about adaptation, and if we don't, we will adapt in a way that we need to survive. That is what we will do as businesses and as business leaders. So it's important, if we all want to be part of this engine, then we all have a part to play in oiling our own individual cog. Can we get better at instructing valuations? Potentially, could we? But how do we get that feedback, and what do we give as a uniformed approach to help the surveyors along? And in turn, when we challenge on something, well, what's a valid challenge? So we're not wasting time where a surveyor goes, well, I'll never consider this item of information. Are there 3 or 4 key parameters? Surveyors can communicate to us to say, these are the reasons why we will relook at evaluation. So you know within that parameter what you need to do, what evidence you need to supply. So we're not just bombarding surveyors with, well, I think this is nonsense and you're a fool, you know, because that's not conducive to a positive working relationship. We have to recognize that we need one another. So what can we do to help one another? And that's what's most important.
I think, Aaron, sorry, really quickly, I think from a lender's point of view, we have to recognize firstly that, you know, bridging has been around for decades, and of course was exasperated during sort of the 2000-2008 crash. But I think it's unfair to say that surveyors haven't adapted, because I think, you know, thinking about it logically, the people behind the desktop valuations are surveyors. The people behind the AVMs, albeit with a little bit of help from software engineers, are surveyors. And without, you know, the specialist bridging and, you know, specialist lending industry is very, very much reliant on surveyors, and it has been since its inception. So I think it's unfair to say that surveyors haven't adapted with us. You know, they are at the forefront of everything that we're doing. So Dan's already mentioned he's the MD of VAS Audit. That is a business that is doing desktop valuations, audits, that they're helping other lenders do things that they would never have done. So they've already adapted, and they are at the forefront of what we do as an industry to be able to say what happens next. I think the reliance on the adaptation isn't with surveyors, it isn't with lenders. That's part and parcel of what we do, adapt to survive, as Aaron said. But I think more importantly, the change has to be with the insurance providers, and that's an education piece. That's for us as lenders and Dan and his business and the rest of the surveyors and brokers to be able to come together and say, you're penalising an industry because you don't understand it. And we need to educate the insurers to help them understand what our business model does, how it is successful, and why it is, you know, so profitable for consumers, for brokers, for surveyors, and for lenders. And I think that's more important than surveyors or lenders adapting, is an education piece to the insurance providers to say, you're penalising us because it's something you don't understand. And to help them understand it would be a much more positive way to get better at what we do.
Yeah, I completely agree with that, and I think I also agree with valuers and brokers having that dialogue as well, and explaining kind of what one party needs from the other and from the outset. So and we've been really trying to push for more education, especially for insurers, and I think that's something that the RICS will also need to play a part in more going forward. I know we're at 2 minutes past 12, so I will need to wrap this up, but we do have one final question. This was for Daniel, who has been carrying the valuation industry on his back throughout this whole hour. The question is, do you feel that valuations are harder to place with valuers now in some sectors rather than others? For example, I would expect to be able to place a valuation in a densely populated residential area without a problem, but it's likely to be harder for me to get the right level of valuer to report on a development site. Is that then leading to perhaps inexperienced valuers dealing in cases where they have limited experience?
Wow. There are certain parts of the country where it's slightly harder. I think we have to differentiate between like a fixed fee type, sort of slightly cheaper residential property compared to a development. You know, I've not come across any situation where we've had an issue getting a development appraisal sorted. I think the market is fairly buoyant in that side. I think because the fees are good, let's be honest, this is, you know, a value will go to where the fees are good, but it is slightly harder for value, to find a value that will pick up in, you know, southeast of England, some of the Midlands, some of the sort of more remote areas of the country, where at a very minimal fee level, yeah, that is harder to get that. You know, we see that, you know, quite regularly because, you know, valuers are busy. You know, let's be really honest with you. I don't see a valuer sat at home waiting for business to come in. They're all out and about, and that's part of the problem about how to get a fee quote back, you know, in a reasonable time, because sometimes they're out doing evaluation and you don't get that. So I think it's more about the work and the level of remuneration for that work. So I think the lower end, yes, it's quite hard to get, you know, a valuer sometimes to go out there, and yes, you know, it's with the average age of a valuer now, and those more sort of regional valuation firms are either disappearing or you know, eventually going to come to the end there, and the larger firms, your medium level firms and your national firms, don't really want to pick up a £80,000 East Manchester property. So I think there's an issue around, you know, that point there. But I think very quickly, just come back to Aaron's point about, you know, where we all sit in the market. There's somebody we haven't talked about who's a major part in this market, and there's actually the funders of the bridges. You know, not all bridging firms use their own money, and you know, when you talk to these people, the big banks, the financial institutions, then they're built on the back of we need a valuation, we need this. So I think there's education all round here, and Michael explained that. I think we've got a whole industry piece about. I came in from Lloyd's thinking that bridging lending was dodgy lending, but the reality is, from what I saw in Lloyd's to what I saw Michael and Meir doing is exactly the same, if not more in depth than some of the stuff we saw in the banks. So I think we need to tell that story to people, that these are not on the back of fag packets. This is a process. We just do it quicker. That's the main point on there. And I think we need to educate the insurers, and I think as lenders, you need to go out and speak to your funders to say, actually, this is the reason why we do this, and it's not as risky as you may think.
Completely agree. We're B&C Magazine has been putting this topic out as a series over the last 12 months, and we will be doing a final part in the November-December issue. So any valuers or brokers or borrowers today who are interested in taking part, please contact me after after today's event. We are now 6 minutes past 12, so I definitely need to bring the event to a close. I want to thank MS Lending Group for partnering with us on this, and also thank you to our fantastic panel of experts for taking the time out of your busy schedules to join us. And I also want to thank you, our audience, for joining us. We will be publishing this roundtable in full next week on B&C for those that weren't able to make today's live event, or if you wanted to rewind and catch up with anything that you might have missed. If you enjoyed this one, we will be doing other events on B&C and DFT through the remainder of this month and next. And also, for more insight and news on the specialist finance sector, you can subscribe for free for our Bridging and Commercial magazine. Our next one is out around the 25th of October, and it's a climate change issue, so definitely subscribe to receive that one. It's definitely one not to be missed. But in the meantime, have a fantastic afternoon, and we hope to see more of you in person. Thank you very much.